It is no secret that the real estate market isn't what it was a few years ago. So if you're a home buyer, you're probably looking at the current interest rates, which are at 6.85% at the time of the shooting of this video, and thinking, geez, what happened to the sub 3% mortgage rates that people got during the pandemic? And while the 6.85% is a far cry from the historic low interest rates homeowners got just a handful of years ago, they are nowhere near, not even close to where the historic high interest rates were just a few decades ago. In fact, I want you to pause this video in just a moment to leave a comment, and I want you to tell me what you think the highest mortgage interest rate was. Don't go jumping on the Google, just go down below in the comments and leave what you think that number was, what that rate was. Hit the pause button and come back and let me know. So now that you commented your guess, here is the answer. So according to Bankrate, the highest mortgage rate was 18.4% in October of 1981. Now the average mortgage rate, or interest rate rather, for the entire decade was 16.64%. Yeah, ouch. Can you imagine paying that kind of interest rate on the largest purchase of your life? Now, look, I'm not going to sugarcoat this and tell you that 6.85% doesn't stink. It could be so much worse though. But given the bargain basement rates that people enjoyed just 4 or 5 years ago, it makes sense why many folks who bought during that time frame are staying put, and why people like you want to buy a home are looking for better options. But what if I told you there is a better option that many people just simply don't know about? And friend, it is called Assumable mortgage, and it can save you, depending upon a few factors, hundreds of dollars a month on your house payment. Now you may be saying, what exactly is a assumable mortgage? Well, essentially, an assumable mortgage allows you, the buyer, to take over the seller's mortgage. So you take over the current principal balance, the repayment period, and the interest rate that the seller is paying. All the other terms of the existing mortgage also transfer to you as well. Now, obviously, the advantage of a mortgage like this is that you can avoid the 6% or higher rates that we currently have and enjoy a much lower interest rate and a lower monthly payment as well. Now, all kinds of loans are assumable as well, including USDA, VA, and FHA loans. You just have to meet the requirements of the loans. So for example, to take over a USDA loan, you usually need to have a 640 credit score and meet other basic requirements. Now, a VA loan requires you to be approved by the lender, but you do not need to be a veteran to be able to assume a VA loan, which gives you a little bit more flexibility. Now, FHA loans have basic requirements as well, like having a 580 credit score or higher. Now, conventional mortgage loans it's a completely different animal, a different story. Now, these loans, which are by far the most popular type of loans or mortgages out there, are typically not assumable. Instead, they usually come with a due on sale or a due on transfer clause, which requires that the mortgage be paid off completely when the owner sells the property or transfers the loan to someone else. Now, with that out of the way, you may be wondering, how exactly does an assumable mortgage work? Well, it works pretty much like this. First, the current borrower signs the loan over to you. You then become responsible for paying the loan. Second, you have to pay the seller the amount that they paid on the loan. So if they have paid off $50,000, well, you're going to owe them $50,000. Plus, you have to pay for any appreciation as well. So let's say the seller paid $250,000 for their home, paid off $50,000, and now the home is worth $300,000. Well, you have to pay the $50,000 in appreciation on top of the $50,000 that the seller has already paid. Now, this amount is part of the purchase price of the property. However, you have to pay that amount immediately. Think of this as part of the down payment. So you pay for this out of pocket, or you can finance the amount using another loan. Third, assumable mortgages come with an assumption fee. Now, this fee, which you have to pay to the lender, is usually 0.5% to 1% of the loan amount. So like any other loan, there are pros and cons to this. So let's dive into the pros and cons, and I guess we can start with the pros of assumable mortgages. So obviously the elephant in the room here is lower interest rates. Now, as a buyer, you may get a lower interest rate compared to the current rates. Next, there is no appraisal requirement. So unlike a typical loan, assumable mortgages do not need they don't need an appraisal, but you should still order the inspections though. Now, there's also fewer out-of-pocket costs, so you may enjoy lower costs compared to originating a new loan, especially if the seller has low equity in the home. Next, there are more offers for sellers. Now, if the mortgage is assumable and it has a lower than market interest rate, it could attract more buyers come to the table and potentially lead to a higher sale price of the home. And while I would love to say that there are no cons to this, there are. So some of the cons with assumable mortgages include limited availability of conventional mortgages. So most conventional mortgages are not assumable, as I noted a moment ago. Only government-backed loans, so the VHA, USDA, and VA are typically assumable. Then buyers must qualify, which is pretty much the same of what you would expect. So as a buyer, you still need to be able to meet the lender's credit and financial requirements to assume the loan. What's more, you can only get financing from the seller's current lender. So there's no shopping around here. Next, seller's equity is still due. So buyers only assume the remaining balance of the mortgage. So you still need to pay the seller for the rest of the home value, either out of pocket or with another loan, which will be substantial upfront expense. Then sellers may remain responsible for debt if the buyer defaults and the seller's debt hasn't been properly released. The seller's credit could then be impacted. Likewise, if the buyer takes over an assumable mortgage and transfer it to a third party, the seller may still be responsible for paying any sort of payments that the new owner misses. Now, these things are, and this is probably the bigger reason why you don't see a lot of these sort of mortgages being executed here. They are quite complicated, and that's probably one of the bigger cons with this here. These loans require a ton of paperwork, and closing often takes a lot longer than traditional loans. So as a result, some lenders and real estate agents don't like to work on these deals that involve a assumable mortgage. All right, so now you're all caught up on the assumable mortgages. You understand the pros and cons and so forth with it. Let's talk about whether or not it might be the right one for you. So if you're lucky enough to find an assumable mortgage with a lower rate, you could be saving, I mean, look, this is what we're talking about. The biggest pro with this here is you could be saving big time every single month. But remember, it's not a one-size-fits-all situation. There are pros and cons, as we established and we echoed here a couple times. And you've just got to make sure that it fits with your financial goals. And if you're a buyer, you still need to be able to qualify. And if you're the seller, you've got to know the ins and outs to avoid getting stuck with the debt. So what do you think? Could an assumable mortgage be your secret weapon in today's market, or are you sticking with the more traditional routes? Drop your thoughts in the comments down below. I would really love to hear what you think. And as always, don't forget to hit the like, the subscribe, and hit that bell for more tips and real estate information. Lastly, if you're considering buying or selling a home, or just simply want some information, I can help you with that. I'm a serial entrepreneur, a veteran, a real estate agent, and someone who has called California home for the better part of 3 decades. I know this area inside and out, and I'm here to help you along your journey. So if you have any questions, feel free to call or text me at 949-726-2601. All right, friends, well, that is all I have on this short little bite-sized video. I hope you found some value with that. With that said, I'm going to be shutting off the cameras, and I'll see you in the next video.